Max, we obviously had an at-the-money offering from one large hyperscaler, and there's concerns that the rest will follow just because the equity risk premium is now negative, so it makes sense then for them to tap the equity channel. How do you feel about that?
Yeah, overall, I'm not particularly worried, to be honest, because this whole equity versus debt, I mean, let's be honest, when you look at equity offerings overall, yes, the dollar amounts sound very, very high. We know that the free float, obviously, is a very different number than the total market cap. That's number one. Number two is, when you look at the dollar amounts even of free float or the IPO that's coming to market, the IPOs that are coming to market this year, plus the equity offerings, in terms of market cap, you're probably more on par with 2020, not with 2021, and you're probably even a bit lower than in 2020. And let's remember, in 2020 and 2021, when you compare this to now, when people say, oh my God, we're in an earnings bubble and it's all just AI and it's tech and it's exuberance, let's remember what we did in 2020 and 2021. We threw money behind SPACs. We literally threw money behind companies where people said, well, I don't really know what I'm going to invest in. I don't know when I'm going to do it. But you know what? Just give me some money and I'll figure it out. And really, we call this a bubble where we do see these crazy, crazy margins. These crazy margins. Look at Micron 2 weeks ago. And we compare that really and call this more of a bubble or even a bubble than what we had in 2020 and with 2021. I think that was really way more exuberant, paired also with much more exuberant positioning, both on the systematic and the discretionary side. So overall, yeah, I can't really get myself too worried about that.
So Max, not for me to say if it's a bubble or not. That's your job. You're in that seat. I'm not a technologist either, but I do look at market signal, and the market's sending a pretty obvious signal, at least from my perspective, to one single name. If you go back a month to the start of June, when we had that FT article that reported that Meta was considering a capital raise, equity, that stock sold off. A month later, we have a Bloomberg story, and they're considering selling excess capacity. That stock rallied. Doesn't the C-suite have to sit up and take notice of those kind of signals coming from financial markets?
Yeah, and therefore it probably makes sense to go a bit broader in your US equity exposure, and not just by the memory and the semi names, right? We are still going to face that shortage probably well into the next year and a half. But is that really the only game in town anymore? No, it's not. That really was the story in April and in May. When you looked at what happened since the end of March, that was when the semi names, the tech and AI names really within the S&P went up almost 50%. And the rest of the market went actually down 10% and only recovered half of its drawdown from the Middle East conflict. We've just now, in the last 2 weeks, went above that watermark. So they're now flat. The rest of that S&P, outside of those outside of those AI infrastructure complex, they're just above 100 now. They're just back to where they were at the end of February. And that's the stuff that I think you want to lean into, play a bit more the broadening and actually play that it's not just semis, it's not just that AI infrastructure universe that's doing well. It's actually the median company. Look at median earnings, for example, the last two earnings season, not only in the US. Look at Europe, you look at Japan, you look at EM. It's everywhere where in the last two reporting seasons, really, median earnings growth has gone up and median earnings surprises have gone up. So Max, it is more of a broad-based fundamental story.
The good news as well, just to jump in for the broader story, is that the rate story has stabilised too. Data was a bit softer than expected on Thursday. Crude's lower this morning, back to 68 on WTI. Brent crude back to 71. Max, do you believe we have removed some of the urgency to do something at the Federal Reserve?
Oh, yeah, absolutely. I think that whole story around Kevin Walsh being the big hawk and us as markets now having to finally price some data and not only rely on the Fed to give us forward guidance. To be quite frank, I mean, I sat there in the press conference and I thought, what the heck have we done so far in the last 15 years? Really? Did we only just wake up like 1 hour every 3 months, look at the dots and then go back to sleep? Really? I mean, this is a slightly bizarre take from the market, I think, to read so much into what Kevin Walsh was saying and how hawkish he was. Remember, the first press conference, he said the 2% target, the 2% inflation target is not up for debate for now. How is that so hawkish? So I think that whole hawkish narrative was too much narrative, not enough backed by the data. And let's remember, when you look at activity surprises, just look at US against Eurozone activity surprises, you really had the third biggest divergence, the third biggest outperformance of US surprises in the last 10 years. So I do wonder now, going into the second half, how much further can that go? That US exceptionalism, that's really making its way into consensus. That was very different 3-4 months ago. If you said, look, no, the US, I know there is geopolitics going on, but the US domestically is doing so fantastically well. That was out of consensus. That was raising eyebrows. Now, if you say US exceptionalism, I mean, your meeting with clients is done after 10 seconds because everyone agrees.
Yeah.
So I do wonder, really, rates, perhaps both front end and long end coming down, that should help also multiples to recover.